Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with my 38th guest, Peter. Peter, go ahead and tell the people a little bit about yourself.
Hi, well, thanks for having me, Troy.
Absolutely.
I am 64 years old. I have been part-time employed, only working part-time since I was age 46. I've been investing for a long time, and I do a little part-time sub-teaching. I am not married, don't have any children.
Okay, cool. Yeah, that's a very good intro. So where about in the country are you? You're in the United States, right?
Yeah, so Hayward, where I live, is about 40 minutes southeast of San Francisco.
Is it expensive there too?
Oh, yeah.
I feel like anything in California is just like, oh, it has California in it, it's got to be expensive. I'm like, that's ridiculous.
Well, even worse, see, I'm commute distance from Silicon Valley. I'm also 40 minutes from Silicon Valley, which is which just sort of just creates the real estate is just incredible because of how close I am to Silicon Valley.
Yeah. Has like the Bay Area and stuff like that, has it gone downhill as much as people are saying, or is that just like a news story?
Yeah, no, that's completely a news story. I'll give you a brief snapshot of really the way it is. The city itself of San Francisco has really been impacted by the loss of office workers. Mm-hmm. And so the consequences of that, and then also the rise of homelessness. So that has and the loss of tourists. So the city itself of San Francisco has suffered from the pandemic and is not recovered. But the Bay Area in general really actually is really has a really safe, clean, things are well run, and and it's really a nice place to live. And also the city of Oakland. So San Francisco and Oakland also suffering badly from a homelessness problem. But those are kind of the Bay Area in general is nice and has low crime.
That's good. Yeah, I and maybe I just think that Oakland and the Bay Area are the same thing, but I clearly don't live there, so maybe that's not it. But like, do you think the off topic, on topic, do you think like the homelessness has anything to do with like, I mean, it has to have something to do with more than just like drug addiction or stuff like that, or gambling addictions that I know a lot of people just nationwide have. But like, it could also be your cost of living is outrageous, and if you don't make $120,000 a year, you're going to live on the streets out there.
Yeah, so where we live, I mean, the cost of living is incredible. Like, let's see, it is sort of standard where a 2-bedroom apartment around here is $3,000 a month.
That's gross.
Yeah, I said 3,000 to a bedroom apartment. Yeah, so that's absolutely a layer of the homelessness problem.
Wow.
Here where I live.
That's insane. Well, good news is you're not one of them because you have a house. So congratulations, you made it. Okay, so you touched on this a little bit. So I want to know, first question is, when did you begin investing? And then when you got started investing, did you start with dividend stocks or did you kind of stumble into it like everybody else?
Yeah, okay. So I started investing a long time ago, 1988. Let me say that again so you get that right. 1988.
That is 6 years before I was born.
Yeah, I was age 28.
Yeah, there you go.
And no, I got into dividends right away. And partly the reason for that was the big crash of 1987. So there was a massive crash in 87. I think it was something like 25% in one day.
Wow.
In October of 87. And then the other thing too is I've always been really risk averse, and frankly, the stock market intimidated me when I began. So I was into dividends immediately.
Okay, so a couple questions. So was the crash of 87, was that inflation related? Because I know in the 80s was when Paul Volcker was the Fed chair, right? And then they raised interest rates to like 18% or something like that. Was that related to that or no?
No. So by 87, actually, the interest rates had totally come off the highs and were no longer double digits and had now gone into single digits. And actually, that crash, had a lot to do with great big difference between the previous century and the 21st century, humans versus computers.
Uh,
So back then, we actually had what there was there was kind of a panic. And because it was all humans on the New York Stock Exchange floor trading, the panic spread quickly. But that crash actually didn't last really long. Um, but you know, it, so there back then, it was a very different world where there was no internet,
yeah.
right? So that was a radically different world. And the crash was broad and only lasted a couple of months.
Wow, so that's weird because I feel like I've been doing some research on like the major indexes, so your Dow, your Nasdaq, and your S&P. And one thing that I do notice, or like have noticed in you know in my research, is that it seemed like the crashes back in the day, like I say back in the day, like a bunch of years ago, it seemed like they were longer. Like it seemed like it did take longer for recovery versus like the COVID crash. Literally, go ahead.
Yes, yes. So no doubt. I mean, so you got the this 20th century where humans are running everything, and you get the 21st century where the machines are running everything. Okay, so now I gotta say recovery time has been cut by 80%,
Yeah.
because the way that the machines are programmed, right? So that comparing machines to humans, so the way the machines are, they're set for a set of parameters, right? And those parameters can cause sell or buy. And so as soon as the parameters hit the internet, the machines react instantly.
Wow.
And
So
you
it's
get the
like the limit orders and stuff, right?
That's one example of it. Yeah.
Yeah.
So right, um, um, radically faster recovery in the 21st century with all machine versus all human.
Yeah, because I mean, like even the COVID crash in March of 2020, that was a big crash, and that seemed like it lasted 3 weeks, and then everything was up, and like it was double the price it was like 6 weeks later. I'm like, that was insane. And then it was 2022. I think we had the down year. Yeah, 2022 we had a down year. S&P was down like 19%. Well, last year it was up 24%. Like we already erased all those gains and then some, kind of thing. So it's just wild how like you almost have to be like on your P's and Q's to buy buy the dips if you're, mentally ready for that. I mean, and that's whole other topic of discussion is like being actually prepared. Like for you said you were risk adverse. So I kind of actually want to get into that. So not really a scripted question, but just one I'm like trying to understand as we get into this is when you started investing in 88, the crash happened in 87. You said you were risk adverse. Can you identify anything in your upbringing, like when you were a child, that caused you to be the way you were? Like, so when you say risk adverse, I'm assuming that when you were growing up, you were more of a saver. Like once you started getting your own money, and then when you became investing in the stock market, that was the big leap for you, was like, hey, instead of putting this in like a savings account or in a tissue box or under the mattress or whatever, I'm going to start investing this in the stock market. Like, is that how it worked, or can you identify anything?
So see, when we start to really reach back in time. See, I was raised by a father who survived the Depression, the
Mm-hmm.
Great Depression of the 1920s, and that had a profound effect on me.
Mm-hmm.
It made me to where money really meant. And this is an important thing that I wanted to say. See, I really feel money is time.
Mm-hmm.
And when I spend my money, when I used to be a salary person back 25 years ago, I was. That is actually time out of my life that I've sold,
Mm-hmm.
and now I am trading for something that I need. So that was taught to me by my Depression era father when I was a child.
Yeah. I mean, it's exactly like I don't think there's any other way to look at it. Cause like at the end of the day, you did have to sell, whether it's you're working a day job and you're selling 8 hours Monday through Friday in order to get whatever the wage is, then you do whatever you do with that money. I mean, that's very true. That's how it is. And it's just, I'm curious about that. Cause like I didn't start with dividend stocks. But I was the same way where like my upbringing was a lot tighter with money, and I could have either said that this was normal or I could have said that this isn't how I want to live, and that's what I did. And I was just a saver. I was like a squirrel hoarding nuts for the winter or whatever. Like everything I got was just saving it, and it was just in a savings account, which is obviously better than spending it, but it was also opportunity cost of like I didn't know anything about the market until 2020 is when I started learning about that stuff. So yeah, that's really interesting. So thanks for sharing that. So what caused you to, when you went from being a risk adverse person and you started investing right after the crash, what was your mindset like right after a crash? Were you like, did you know it was, safe by then, or did you think that there could be some more room for downside? Like, how did you just jump right into the dividend stocks? Was it because they were seen as less risky, or how'd that work?
Okay, well, I'll answer that, but before I do, I want to say one other thing I should have mentioned is, so I have a degree in marketing from Santa Clara University, and that has also substantially affected my outlook on business, money, and stocks in general.
Mm-hmm.
Okay, now as far as the very beginning, when I was risk averse and I jumped in, so really, I gotta say, was I had a couple of bosses who were cruel, and it inspired me because I thought to myself, I was poor, I was young, I was 27, and these people, I lived paycheck to paycheck, and they owned me. They owned me because
Mm-hmm.
I lived paycheck to paycheck. And then I found out what was an IRA, and I played tennis with a guy who worked for an insurance company, and he explained to me the concept of an IRA. And the big thing right away that attracted me was it you deduct your contributions from your taxable income.
Mm-hmm.
And so really that bad bosses and cutting back my tax bill really inspired me to invest.
Wow. So do you, I mean, I don't even know if you can answer this question, to be honest, but do you think that if your, first boss, second boss were like really good to you and you didn't hate being at work and stuff like that, if you think if that was the way things were, that you would have been on a completely different path?
Well, um, I wouldn't say financially a completely different path. Probably my sense of urgency would have been less,
Mm-hmm.
and I probably would have maybe not. I maybe would have had other priorities that are sort of were in the mix
Yeah.
instead of really being laser focused on not being controlled by a paycheck.
Yeah. So I mean, you really attacked the investing and dividend investing strategy from the point of view of like, hey, I want to be, you hear it all the time. I want to be financially independent. I want to be free of the 9 to 5, having to work with somebody or work for somebody or work with people that you don't like, and you can kind of do what you want.
Right.
Yeah, I like that. I mean, that's a crazy. I mean, starting at 26 or 27, however old you said you were when you first
28.
started. Do what?
28.
Okay, yeah, 28. Like that's young by the average investor's point of view, especially back in the day. I feel like it was even less common. But
Oh,
yeah,
my friends thought I was nuts.
yeah, well, yeah. So like that's the thing is like I know kids now, like people that I've actually interviewed. Somebody that was he was like 18, 17 when he got started. And I'm just like, dude, the amount of compounding you're going to have over the course of your investing journey is ridiculous. So like relative to like when you could have started, it was quote unquote late, but obviously any time is better than never. And 27 or 28 when you started is way better than nothing. Like I started in 2020. So I was, what'd I be, 24, something like that, 25. So like I've been doing it for 4 years by now. So it's yeah. Of course my biggest regret, and I'm sure yours is now, because you get to see all the time and all the decades of compounding that you've had, and you're like, man, if I would have started at 18, this could be so much better. But at the end of the day, we can't do anything about that. Like it's in the past, so we just move on. But
Well, actually, I mean, now let's say uh, that's actually not that's not a big regret for me.
hmm,
Now, I'm glad that we're talking about it though, because uh, when I'm putting out my perspective on things, one of the things, every time I meet someone who's younger than me, I ask them, have you started saving for retirement yet? Not everyone, but a lot of people.
Hmm.
And if they haven't, I push them a little bit because it is such a big deal, right? Time, I tell them, time is the most powerful thing, you know? So, um, if let's see, if I had a big regret, I don't know. No, actually, I do have a big regret
Mm.
is being scared off of Amazon and Netflix because of their astronomical PE ratio.
Mm.
So I didn't get into Amazon or Netflix because the PE ratio um, it discouraged me, and I was wrong, and I regret that.
So, I mean, that's literally my next question was going to be like, what is your biggest, well, so, okay. So Amazon and Netflix, neither one of those currently pay a dividend, and they didn't back then, obviously. So like, is there a dividend specific mistake did you make any of the same mistakes like that with dividend stocks where like the PE ratio scared you away, or was the dividend mistake that you made, was it different? And also, I always like to draw this part of the question, because this is the most important part. Is more important than the mistake you made is what lesson did you learn from making that mistake?
Yeah, yeah. So actually, I thought about this a little when I saw the sample you sent me.
Mm-hmm.
So I got a story for you. Okay, this is my big uh, epic fail. Okay, so it's 2010. I'm collecting mega dividends from oil. Okay, heavy into oil because of a lot of reasons. One of them was oil in the 2009 crash. Oil crashed to $35 a barrel. So that inspired me to get into oil, and I was making a lot. And then what happened was British Petroleum, and I had about a 3% position in there. That was like 15 grand at that time. Um, Great big well fire, 9 people killed, major explosion, catastrophe. Okay, so the stock drops through the floor like a hot missile, and I say to myself, they put the fire out. This is over. This is a golden opportunity for me to cash in when there's blood in the streets. So I bought another 3% of BP. Well, then, and this is all, and I was major, oil has paid a good dividend for a long time.
Mm-hmm.
And I have been in oil for a lot of reasons, but one of them is dividends. So anyway, it took them 3 months to cap the well, and the stock didn't go back up; it went down further.
Mm.
And I really got hurt by that one. That was my biggest one.
So what would you say, like, what's the takeaway from that for you for like
Yeah,
future purpose?
yeah. So it is great to look for distressed stocks to buy. There are times when you have to do that. But the thing is that, um, I realize now that I am not the most sophisticated, perceptive person in the world. And I am not equal to the incredible tech power of Wall Street for placing value on stuff.
Mm.
So I actually am really cautious about reading Wall Street and reading the signs, because actually, so I rely really less on my own viewpoint and more on a broad viewpoint. And that's going to be my lesson that I take away from that experience.
Yeah. I mean, so there's so many, like, I don't personally like looking at like sayings and stuff, because I've brought it up on the interview several times before. I feel like there's a saying and a counter saying to everything. My example is always like the one saying is like, good things come to those who wait. But then the counter saying to that is early bird gets the worm. So I'm like, okay, am I supposed to like hurry up, or am I not supposed to hurry? Like, am I supposed to be patient? Like, what am I? So like literally somebody's like, oh, you know what they say this. I'm like, yeah, but they also say the other thing. And I'm like, it's just whichever one you want to pick. So do you think, so what there wasn't a lot of like stuff that there is today, obviously, like fractional shares that didn't exist back then, to my best of my knowledge. You still had to
No,
pay for trades.
yeah,
So do you think that if you were in the same position today on BP, Do you think that the introduction of those features that we have today would have made the mistake worse or better in any way? As far as like maybe you could have bought, like I do dollar cost averaging. So say you were putting another 3%, which you said was 15,000. So instead of putting another 15,000 into BP back in 2010, maybe you do 1 month where you put in 5K, another month where you put in 5K, and another month you put in 5K. Do you think that would have made it better or worse, or how do you feel about that?
Unfortunately, BP was a disaster,
Mm-hmm.
and there wasn't really a good way to win. I mean, it took years, and I think it took like 4 years for BP to recover from that.
Do you still have it?
No, no, I don't. But when you to answer your question, are you talking about with what I know now or what I knew then?
So I mean, we actually have a question on that at the end. So we'll save whatever you're gonna talk about. That's
Okay.
one of my favorite questions to go about at the very end of the interview. So there's a little hang on, little cliffhanger in there. So okay.
Okay. So then, in terms of then versus now, is I think that there was now in 2010 there was a significant amount of computer trading going on.
Mm-hmm.
And so now it's 14 years later. So I would say the thing is that now it would have been way faster, like we were talking earlier, and also the speculation about the speed of the recovery would have been vastly more in depth.
Mm-hmm.
I mean, we actually have a treasure trove now of information and insight that is, even is vastly better than even 14 years ago.
Mm-hmm.
And so, like, what I like, and I'll give you an example of this is, how when people miss earnings, it is not rare for them to go down double digits or 20%, right?
Mm-hmm.
Right. I like that. I think that shows a healthy market. That when you aren't doing it, when your earnings report is not hitting the marks, the bright lights are shining on your errors, and your price of your shares reflect the truth.
Mm-hmm.
And so it's better that is way better now than it was in 2010, and I love that because the truth comes out.
Well, yeah, I think that stuff's really wild too, because like a company could come out, like let's just say Coca-Cola. It's everybody knows Coca-Cola. So like Coca-Cola could come out. They're like, hey, for 2025, we're not expecting great things. We're expecting 2 or 3%. These analysts will come out and be like, hey, we're putting expectations at 5% for Coca-Cola. Coca-Cola doesn't meet the expectations, so they underperform, but they still meet the 3 or 4% that they said they would. But then the stock price drops. I'm like, whose fault? Like, Coca-Cola did exactly what they said they were going to do. The analysts didn't listen. And now you say I underperformed because of what you thought we were going to do, even though we told you we're not going to do that. And I'm just like, that's so wild. Like, I don't get that.
Yeah. Yeah. And, that's one of the reasons why, when people ask me about, like, say, non-investors or less people who just have a 401k, they ask me, give me a stock market recommendation. I tell them, stay out. I say, get an index fund, get an S&P 500 index fund, and don't buy individual stocks. Mm-hmm. That's what I tell my friends.
Yeah. Well, I think that's really good because I think that the type of person that is asking that question, that is the response they should get. Because if I see it all the time on the dividend groups and stuff that we're part of on Facebook, where people ask like the most broad, unresearched question in the history of questions. They're like, hey, I'm looking for the top 10 growth stocks. I'm like, cool. Like, aren't we all? Like that? Why, you haven't done the due diligence on your own for me to give you an intelligent response back, especially when you're asking a question you can literally Google. Like when you get to groups like this and it's like, and it's not like we're some elitist group or anything, but it's like, show me what you've done, show me what research you've done. And then you can ask our POV, our point of view on that said thing. Don't ask some broad Google question and then get everybody to do the answers for you. Because the answer that you give to those people is exactly the answer they should get. Hey, you're clearly not at the point that you need to be asked, like that you need to make your own individual picks. You need to be picking the index. And at that point, you can either learn from the index and you can branch out from that point, or There's no shame in the game of just being an index investor. You're probably going to outperform 90% of the people in the group anyway.
Yeah. Yes.
That's my soapbox. Sorry, I'll step down. Your turn.
I'm glad we touched on this, because people who are going to trade individual stocks, you understand this, and they really don't. That, you know what, you're catching snakes with a pair of pliers.
Mhm.
That's what it's hard.
Yeah. Well, and like even on my channel, like most of the time, like I'd probably say every time, anytime I, do my power or my top 5 that I release on Fridays or whatever, all those stocks have shown histories of outperforming the market. So there's plenty of stocks that have done it. It's just a matter of like, do you own enough of that stock? When did you buy that stock? Do you have the courage and the gumption to hold that stock in bad times, and like all kinds of stuff like that? And that's like the emotions and the psychology of the market that people can't deal with. So like what people do is they're like, like there'll be people that have owned, let's just say Boeing, because Boeing's like the stock everybody wants to beat up on now because their stuff's falling off their plane. But so like Boeing might be the 2024 example of BP. Like who knows? Like it could be a great, like it's getting destroyed right now, and it could be a good recovery story, or it could never recover. I heard Airbus, I think it's an overseas company, but Airbus is doing a really good job of actually providing quality products that's the same thing as Boeing. So. But yeah, so I just see, I don't know, it's just stuff like that where like, okay, yeah, everybody can buy and hold a stock when it's, Nvidia and it's going up and it's only going up. That's cool. But like what happens when it does drop 20% and you didn't buy it because you found this stock, you bought it because somebody on Facebook told you to. Like that's when you lose conviction.
And I think what, one way to sort of summarize your point that I think is everybody should understand is that finding good companies is not hard. Mm-hmm. That part is not that difficult. Okay. The difficult part is when and how much.
Yeah. Yep. And at the end of the day, it's your risk tolerance. There's one company I own. It's one of my favorite companies in my portfolio is Pool Corp. POOL is the ticker. Nobody's ever heard of it. Every time I bring it up, it has great dividend growth rates, like 16% over the last 3, 5, 10 years, like really good dividend growth rates, outperforms the market, dividend streak of north of 10 years, all the things. But it's, for whatever reason, I don't understand how a pool supply company can be so volatile. It's up and down like 2% one day, down 0.5%, like all kinds of like crazy stuff all the time. Like it's like a tech company, and people just don't have like, they want the volatility, but they only want the volatility when it's up. They're like, oh yeah, it went up 8% today. That's cool. But like everybody wants that. Volatile stocks are volatile both directions.
Yeah. Mm-hmm. Yeah,
like look at Tesla. Like I know it's not a dividend payer, but literally Tesla will be like, oh, it's up 8% today. Oh, it's down 7% tomorrow. Like who knows where it's going to go?
Yeah. Yeah. No, and that is a thing that, was for people in general. So I'm glad now we're talking about risk. Mm-hmm. And I'm really glad to hear that, because, that is this volatility, you can have a good company. But if you're not accounting for volatility, you can you can fail.
Yeah. Well, I mean that's how you get to the people that are, what are they, the buy high, sell low people, because they get scared that they're going to miss out, so they buy it when it's going up, and then it comes down, and then they're like, oh, now I really shouldn't own this, and they sell when it's low, and it's the opposite of what you're supposed to do.
And so I have something I want to show you.
Okay.
It's all about how I do risk. Okay, so let's see. Okay, so this is what I call this. That's risk
upside down.
Pyramids. Oh, it's upside down.
There you
go. Okay. So what it is what would be, let's see, on your right is the amount of risk represented by a pyramid. Where at the top, we have the really highest risk, where the pyramid's very wide, okay? And at the bottom, we have the very lowest risk at the tip of the pyramid. The other one on your left is the amount of money that you have in any individual stock, okay, or bond or whatever. So at the top, where the risk is really high, you have a very small amount of money represented by the tip of the pyramid. And then at the bottom of the pyramid, you have a very large amount of money, but that's at the very lowest risk level. So am I making clear on my message here?
Yeah. I mean, if I'm reading it, it looks a little weird as far as like how you have the upside down on the right and the other one. But like in theory, what you're saying is that you're going to have more money in your lower risk part of the pyramid, and you're going to have more money in the higher risk part, right?
Less money in the higher part.
Okay, yeah, okay. So yeah, see that's the confusing
Yeah.
part. But okay, so
More
less
money
money
lower
in the
risk.
higher risk and more money in the lower risk for stability.
Yeah.
Okay.
That's so. So when I figured that out long ago, that was such an incredibly important. And that goes to where dividends,
Mhm.
because um, I've had over 50% of my money in dividends for a very long time. I'm talking about since 2010. Actually, 2010, I really jumped heavily into dividends, where like 2/3 of my holdings pay a dividend. Now I'm even up to, I think, 3/4 of my holdings pay a dividend. And it's because of that, because being a risk averse person, so I use dividends to manage risk.
Mhm. Yeah. I mean, your segues are phenomenal, by the way. So my next question was actually going to be like, how has your investing style changed from when you first began to now? So like now that you are to the point where are you living like fully off your portfolio, or just at least partially off your portfolio now?
Partially.
Okay, so
Yeah.
like okay, and this is actually a really good topic because like diversification is a topic that we're going to talk about. And one thing that I think is underrated, and I talked about this to other people before, but you being at the part where you're actually living partially off your portfolio, you're going to be able to provide more insight to this. So, what are your thoughts on people that only diversify their portfolio via the stock and via the industry that are actually at the point in their life where they're living off their portfolio? And what I mean by that is, I think that another version of what you need to diversify your portfolio is, especially when it comes to the point in life that you're at right now, is the diversification of income. As far as not necessarily, what kind of income, like that's all the same. It's money I need to spend, right? What I'm talking about is you don't want 17% of your income coming from one stock. You don't want 13% of your income coming from another stock, because if you're in the position where like AT&T is a big holding of yours and AT&T goes through a 50% cut and you're at the point where you're living off your portfolio, or you need your portfolio to produce income that you can live off of, you're going to get screwed. If 60% of your income comes from AT&T, they do a 50% cut. What are you doing? Going back to work is what you're doing.
Mm-hmm.
So I just think that's an underrated thing I hear nobody talk about. It's always, oh, I want to diversify by asset class and by sector and by stock and this and that. I'm like, okay, but what about diversifying your income as far as it can? You don't necessarily have to have a rental property and a dividend portfolio and all these different. Those are nice if you want to do those, but if you don't, diversifying the sources of your dividend income, I think, is very important.
Yeah, and see, I mean, because the thing is now when you're talking about dividend income, you're talking about money that you want to look at in the very short term.
Mm-hmm.
And so that means if you have a big fat position in something, and they all of a sudden suspend the dividend or something like that, that's money that you had planned on using, in the next 2 weeks.
Yeah, that was your mortgage.
Yeah,
Yeah,
right.
yeah.
Yeah, so that's yeah. So they're where that level of diversification, right, is where when it comes to the steadiness, right, the evenness, you don't want a volatile dividend stream.
Yeah.
That's high risk.
Okay, so that's actually a good question. So currently with my portfolio, I have 11 holdings. I have one holding that pays out in 14710. I have, I think, 5 holdings that pay out in what would it be? 2511 or 25811, whatever. So February, May, those. And then the rest of my holdings, the other 5 or whatever it is, they pay out in 36912, right? So is that something that you've considered at the point in your life where you're doing your dividends? Or do you just, like, I've heard people say that they do consider that when they're living off their portfolio, and then other people say that they just budget it. Like, they know that 36912 is going to be their big payers. So they have a lot of money, in theory, extra money from 36912 that they don't need, but they might have a lower month in January. So they take some of their money from that they got paid in December and put that towards their January expenses. How do you do that?
Yeah. So see, I'm in the camp where the schedule of payments is irrelevant to performance.
Okay.
So I disregard that completely, and I'm right. So I'm managing the cash flow, like where I sit on 20 grand cash all the time. So nobody's gonna throw off my monthly bills are 3 grand a month. So nobody's gonna have inconvenience me by when they pay.
Yeah.
And then because I'm going to say I believe that is irrelevant to performance.
Yeah. I have the portfolio ideas that I made for the so I have an anyone can invest series where I do keep in mind the payments. And the only reason behind that is because I know other people care about that. So I was like, what I don't want people to do is I see so many people, especially on our dividend group, they're young kids, they're, in their 20s, whatever. And they're talking about, like, they put a screenshot of their portfolio on there and it's all monthly payers. And I'm just like, what are you trying to accomplish? You're just trying to get dividends frequently. You don't care what happens with your original cash. Like, you just want money reinvested back to you, even if it's literally they're giving you your money that you gave them, minus some money. So what I did with that portfolio and also my getting paid weekly portfolio. Now, I only own one of these portfolios. The other ones were just ideas. Is I was like, okay, if people are going to care when they get paid, I at least want to give them good options to do so. These are all quarterly payers. None of them are monthly. But the combination of the 12 stocks that all pay quarterly will get you paid weekly. And that's what I did for several different portfolios now. And the idea was exactly that. Instead of you buying all these REITs in a taxable account and paying taxes on that because it's not a qualified dividend, and you're buying companies just because of when they pay out, I would rather give you options on, say, hey, you do need a company that pays out in January. Here's 4 good options you can pick from. So yeah, I do that, but I don't know. I obviously am far away from being where you're at, as far as, living off my portfolio, or at least supplementing my income with my portfolio. And right now, like I said, I'm not necessarily even definitely right now, I'm not concerned with when I get paid. It does stink to only get one payment in January. That sucks. But other than that, like, I just buy companies that pay, and then whenever they pay, kind of the dividend is important. Obviously, I'm buying companies that pay dividends. But the most important thing is that I'm not losing money, and I'm actually making money on the capital appreciation side as well.
Yeah, and now, and you remind me of two things that I always got to remember is that I'm pretty old, man. I'm 64, and so how old are you?
29.
Okay, so there's going to be some radical differences in what's good for you and what's good for me.
Yeah.
And we need to, and that's one thing that I don't like about the Facebook group is that they don't they don't factor that in all the time when they really should. And the other thing too is as far as options, a great treasure that we have these days is choices. Oh my God. And so, right. So for you to give somebody a set of choices that allow them to manage their dividend stream over time, is actually, since we have plenty of choices that you can give them. And so if that works for somebody who's 29, it's very accessible.
Yeah. Well, and to me, like I said, my personal portfolio, I don't do that with. But what I did want to do is I know that there are so many people, because when I first started, I was the same way. I was like, okay, how can I get as many dividends every month as I possibly can? And I was doing monthly ones. I was doing high yields. I was doing all these different things that everybody seems to go down those paths. And I was like, okay, now I really learned that the frequency of the payment doesn't matter as much as the quality of the company. So I was like, okay, I want to give people like you said, the options of here's quality companies, and the combination of these options will get you paid every week if you choose to own all 12. And if you just want to pick one or two or whatever of these and add them to your portfolio, then they can do the same thing and, bolster your gains and whatever. So, yeah. So speaking, man, you're killing the segues. You need to get on your own talk show. So speaking of the next thing. So the next thing is, what are some of your short-term goals with your dividend portfolio? So let's just say for the rest of 2024, what do you hope to accomplish? And then also, what are some of your long-term goals? So like, let's just say 5 years from now, what do you want to get out of your dividend portfolio?
Okay. All right. So in the short term, actually, it's a wonderful question because see, I'm thrilled now about this. I'm reinvesting at an overall my whole portfolio at 6.2%. My drip goes back in at 6.2%, which I find actually thrilling.
Yeah.
So in the really short term, so I've been on full drip for 2 years. Okay. And I have increased my dividend income by 40%.
Wow.
Now, I did have also a fair chunk of cash that I had, waiting for something to do with when all the rates started happening.
Yeah.
I didn't just have drip; I had some cash. So this short-term situation we have now, I'm telling everybody, me, you, this is one thing that not so there can be different right answers for different people.
Yep.
I think this is the right answer for everybody. While these rates are high, drip your ass off.
Yeah.
Now, in the longer term, like 5 years from now, so now, uh, you know, that really, I would say, so here's the thing is that my portfolio I have the classic the barbell portfolio. So I own Facebook, I own Broadcom, I own Nvidia. And so really I own them in case I live to be 90.
Hmm.
So where I've got a bunch of I have ETFs that they do a big chunk of my dividends. You know I I've got a preferred stock ETF, and I've got a market. I've got HYG, the market tracker ETF, and I've got JEPI, and but I still but anyway, my point is that for the 5 year term. See, well, these rates are going to be temporary, and what's going to happen is that things you buy now, in many cases, that pay a dividend, when those rates fall substantially, like say rate cut number two, we're going to have capital appreciation of things that pay a dividend, and that's probably a year or two out. I'm gonna so I'm thinking that like I said, so it all okay. What's going to be the pace of rate cuts? The $1 million question nobody knows the answer to. But when when we have a second or third rate cut, the things you own today that pay a dividend are going to go up substantially in value.
I like that crystal ball you got. That's I'm not mad at that answer. I like that. I like that. So I mean, so that's I'm wondering, and again, this is part of my research that I was doing with the market and stuff. I'm wondering, everybody's sure, well, in theory, most people are sure that we're going to get rate cuts. Most people seem to think it's like two or three at least. I I just don't know. Looking at what I see as far as the economy, unemployment rate, the everything else that's out there, like the inflation's the only thing that's still worrisome, right? Like it's still higher than they want it to be, but everything else is on the up and up, like in the good way. So like raising or lowering rates only increases inflation. So in theory, they need the other things to get worse, which Jay Powell said in the beginning, right? Jay Powell said that we need, unfortunately, unemployment's going to have to go up and all those things. So, like, I just don't historically speaking, our interest rates where they are right now are kind of where they've been. Like, they're a little bit higher than normal, but, like, not by much. So, like, I don't know, like, are we sure we're going to cut? Like, are we sure it's going to be a big cut?
So yesterday I saw Professor Jeremy Siegel on CNBC, and he's a professor of business at the University of Chicago.
He's really animated when he's on there. I like watching him.
Oh, good. Okay.
Yeah.
And he addressed this point. Okay, and he said, you know what, things now are good.
Yeah.
We don't change. So like what he's talking about is S&P earnings. S&P earnings are robust, are good. So now that is somewhat of a barrier to rate cuts. And like you said, exactly, Jeremy is saying, right. I mean, having the circumstances deteriorate and become worse would actually make rate cuts faster and more likely. So yeah, so as far as he is saying, and I really agree with him, is that these high interest rates are not a troubled environment. Now, probably they're a little on the high side. Probably what might be so here's like Jeremy says, we ain't going back to zero.
Yeah.
Sorry, not happening. Not happening. Now, we're probably going back to 3 or 4. We're not going to stay at 5.25. So, like Jeremy says, and I agree, is that the happy medium is not 5. We're not going to keep 5. We're not going back to 0. What would be the best is S&P earnings stay on their healthy trajectory, and we maybe go down to 3.5 or 4.
Yeah. I just think, like, I know so many people that are in like different dividend groups that I'm part of, where they're like head over heels with all this REITs, all the REITs and stuff like that. And they're like, oh, these things are going to skyrocket when rates are getting cut. I'm like, okay, but first of all, I feel like real estate is a little separate with this statement I'm about to make, but I do feel like the market's already priced in rate cuts. So much so that every time Jay Powell talks and he doesn't lower rates, the market goes down. Like, what was it, Thursday? Like, at the time of recording, Thursday, he didn't say anything about a rate cut, and the market went down like 2%, like immediately. Like, it fell off a cliff. And, like, people are so ready for him to just say, we're going down like a quarter of a point, and people are going to lose their minds over that. I'm like, guys, first of all, market's already baked that in. And second of all, what impact do you think a quarter of a point has in your daily life? It doesn't. Like, it literally doesn't. Like, if you got a quarter of a point raise at work, you'd quit. Like, and you're out here worried about quarter point raises. Like, what are we talking? So I don't know. Like I said, you don't know. I don't know. Like, nobody actually knows. But like, I was just thinking about that. I was like, everything else other than inflation's still higher and people expecting rate cuts, everything else is good. Everything else. So like, and like you said, you can't cut to 0, because if something else happens where you need to create a fast flowing economy like we did during COVID, you can't go to 0, because what do you do after that? There's nowhere to go. So like, you do have to keep it, like you said, 3, 4, 5%, like somewhere in that range, 3, 4%. And like that's just where we stay. So like, people seem to think that we're going back down to where we were at COVID. I'm like, you're off your horse.
No, yeah, that's beautiful, right? And I think so. You bring up a couple of things that I think are really accurate about the reality of where we are. The giant run from October to now, right? I think it's at 25% in the S&P. Okay, that's pricing in the fact that Powell convinced everyone that you're done with rate hikes. And just that fact, we are absolutely done with rate hikes. That was a big part of this 25% run over the past 4 months, pricing in that fact.
How much, this is just for fun, how much would the market crash if Powell, the next meeting, raised rates by 0.25?
What do you want to make a disaster movie?
It would like literally a quarter point doesn't matter in the grand scheme of things. Like, because everybody, like, I'm looking at like fast graphs and all I don't pay for it, but I watch Chuck Carnevale on YouTube and stuff. And like, he's talking about the S&P 500's it's overvalued to where it should be as far as like all the historical ratings and stuff. Like, it's getting a little frothy. So everybody's saying we're due for a correction. But I don't know. Going back to the sayings, like one of the sayings that I think is hilarious is they say that bears are never wrong. They're just early. And I'm just like, that's kind of cheating. Like, I feel like I could be like a meteorologist with that. Like, it's going to rain every day. It never rains. Then like one day it rains. But like, told you. Like, that's just how you're right. And I'm like, that's the same thing bears do. Where so like, you'll constantly hear, what was it, from 2013 to 2020 was like one of the better bear market or bull markets in our lifetime, or in my lifetime anyway. And like, I guarantee you, if you go back through Google, you can find some article by somebody every one of those 7 years where they're like, hey, we're overvalued, we're due for a correction, it's something bubble, whatever they want to call their bubbles that time, like something's gonna pop, whatever, and then it keeps going up, and then it just happens. So same thing was supposed to happen last year for 2023 when the S&P 500 was up almost 25%. And everybody was like, oh, we're overdue. It's all this everything bubble, whatever they wanted to call it. And had you listened to that, you'd have missed out on 25% gains in a single year.
Yeah. And that's what that reminds me of what I said earlier, why I like when you report earnings and you lose 15 to 20% of your value. Okay. And I like it because what it means is that this market is doing a good job of pricing assets. Mm-hmm. If you have cash flow and profit and prospects for the growth in the future, the market is going to tell the truth about that. And if you don't have any cash flow, you don't have any profit in this market today, and your future that looks dim, the price is going to reflect the truth.
Yeah. Yeah, I agree. And like to speak on that, like it's not even that like at all times the market price is accurate for a company, but over the long haul, because you'll have things that get undervalued, things that get frothy, and they get overvalued. But it like that's why I do dollar cost averaging every day. I know it's a little like stressful for some people to think that I literally buy stocks every day, but I just got tired of like I was trying to figure out how I could remove the emotions from my purchases. And I was like, I don't want to care if so-and-so's up 0.5% or down 0.5% on a daily basis. If I buy every day, I'm getting good prices, I'm getting bad prices, and over the long haul, I'm adding more shares of quality companies, which is the goal.
Yeah.
Like I have 30 shares of Apple. I want to own 300 shares of Apple. How do I do that? Do I wait until Apple hits $7 a share and load up? Or do I just keep buying, pretending it never hits $7 a share, and eventually I'll have what I need?
Yeah. And, I mean, I have lived a life of dollar cost averaging.
Mm-hmm.
And I feel precious joy, especially when I was your age, or even like say in my 30s, doing the dollar cost averaging thing, and this we're a little bit on the stock market's a little bit of a roller coaster,
Mm-hmm.
and like one of the reasons I'm trying to be humble. I am not some kind of crystal, some guru where I can really predict things. It's hard.
Yeah.
This is hard, man. So when you know that there's going to be a roller coaster effect that you can't predict, then dollar cost averaging, becomes sort of the logical sort of neutral bet.
Mm-hmm. Yeah, I know you've seen it because you're in some of the same groups I'm in. You've seen people that are older that have had the experience of Apple and all these Microsoft and all these companies being not necessarily in their infancy, but like younger in their life cycle. And people, the one thing that I just don't understand about like you can call it value investing in general is they pick this number based on some metrics that they chose to say that this stock needs to hit certain price, and they won't buy it until it hits that price. And like that's just so there's several people in the groups that we're in where they're like, yeah, I really wanted to own Apple and I never got a chance to because it never hit this imaginary number I pulled out of the sky. And I've said it 100 times before on this interview series is like, to me, it doesn't make sense to wait for a 2% price reduction that may never happen, and then you miss out on hundreds or thousands of percent gain all for 2%. Like that doesn't make any sense.
Yeah, yeah. And especially when like we definitely are headed in one direction or the other.
Mm-hmm.
Like now, the thing is, the prospect of no more rate hikes and the prospect of a rate cut is got a giant bid under this market, like a bonfire.
Mm-hmm.
And so you're waiting for something. You're waiting for a pullback now. You're gonna freeze. You're gonna lose out. It's gonna be hard. But the thing is also I'm a real advocate of having a cash position that is really for the purpose of some sudden opportunity. I considered the COVID crash was a great deal
Mm-hmm.
for me, and so was the rate hikes. So where your overall strategy is where you're not going to be able to call the ups and downs of the roller coaster. Okay, but once in a while you're going to have something that is really an obvious opportunity. And so having a couple percent sitting on the sidelines for that is that what I do.
Yeah, I think that that's a lot easier to happen now, as far as because the cash that you have sitting on the sidelines is gaining 5% interest. Like, I think I do want to know, like, and you can answer this question too. Like, I do want to know, how does that work when interest rates go down? You're getting 1% on your money, and like you're, kind of like they call it the dry powder, the rainy day fund, whatever it is, and you're holding that money there, waiting for something, knowing that you could be getting 4, 5, 6, 7, 10, 12% returns on your money had it been invested.
Yeah, I mean, what a gargantuan contrast, from 2013 to 2019 when rates were zero,
Yeah.
right? And I mean, I did it. I had a dry powder fund, but it was painful to have it sit there at 0% when I saw things that looked good, but I knew I was waiting for the shit to hit the fan.
Yeah.
That money was for that. And when we had the COVID crash, I bought $500 a day for 60 days,
Wow.
right across the bottom. And because I was waiting, I had the money cash waiting for something, for a chance. And I got that chance. And I just $500 a day, $500. I didn't even care what happened to the market. I just put in $500 a day from April to May.
I feel like you almost took too long.
Yeah, absolutely.
Yeah.
And so the end of that $500 a day wasn't very profitable, actually. It
Yeah,
really wasn't.
I feel like if you would have put like $2,000 a day for 3 weeks, you'd have done better.
Better, absolutely. You're absolutely right about that. That would have
Yeah.
been better. And there, you also, and you reflect something else that it's been a layer of many of the things we talked about, is the machines make shit happen so
Yeah.
fast, including that, and including when you miss earnings, and in various other ways you were talking about. Man, those machines, they're like a loaded spring.
Mhm.
And once that trigger gets hit, that algorithm, whatever the parameter is, like let's say, volatility or momentum or whatever it is, you've seen what happens.
Yeah. Well,
Machine,
so I watched a video the other day because I'm not like a really big reader, so I like watching a lot of videos and stuff like that. I might read like an article, but like as far as books, I just don't. I not no shade to anybody that does like it. I just can't focus long enough to read a book. But the one thing I was seeing that was really interesting was like the self-fulfilling prophecy of like the traders, like the people that read the charts, and they're banking on people using what's called the anchoring method. Have you ever heard of that?
not by that name.
So the anchoring method is just the theory that basically I was doing research on like 52 week highs and 52 week lows. Basically it was saying, hey, 52 week high, that's just literally a arbitrary number that we pulled out of space. We're like, oh yeah, year, what's it doing in the last year? Where is it relative to where it was this time last year or whatever? So like that was based on that. And then they were talking about for like when people do trading and they have like the resistance and from the highs and the lows and the 200-day moving averages and all that stuff, all that's based around the anchoring theory of just like, oh, it's like there's this imaginary ceiling. And that's when you'll see like a lot of resistance on like the before something quote unquote breaks out. It breaks out from a number that we just picked. If you'd picked the 267-day moving average, the line would look completely different. But like we're just picking this random number, but so many people agreed to use that number and they create resistance barriers. And you can literally see it in stocks where they're like, oh yeah, so going back to what you're saying about like computers and the algorithms and all kinds of stuff, the machines are set when this thing hits a 200-day moving average, sell it, buy it, whatever. And they just do things. So that's why it's so hard for it to break through those things because of all these things like that.
Yeah, exactly. And so that's the layer. And that brings up another point about this the machine trading is, so I think let's see, the S&P is at 5204 right now. Okay, so I gotta say, out of that 5204, I bet you 500 points of that is pure momentum spec.
Mm-hmm.
Nothing else. So there's like a frothy tip of the market that is purely machine-driven momentum speculation, and has nothing to do with PEs or earnings or share price. None of that.
Yeah.
It's just momentum spec algorithms. Oh, the top 10% of the S&P 500. So so what that does is that it sort of it's a smoke screen in front of the real value of somebody who's got fat cash flow and a full order book.
Yeah. Yeah. I don't know. Just stuff like that's just stuff that I like learn little bits over little bits. And like, I just start diving into it. I'm just like, hey, like, I don't know where I'm going with this, but like, just walk with me through whatever I'm about to ramble with. I think it'll make sense to somebody. So I just wanted to share that. My most recent thing I watched was on the 52 week highs and 52 week lows and stuff like that. So, okay. So I'm curious with this. So like over the course of your journey, you've obviously achieved many milestones, right? In your dividend thing. So first of all, how do you track your dividend portfolio? Do you use Excel sheets? Do you, what kind of metrics do you look for to track long-term performance? And then the thing that, like the main question here is, What role do achieving those little milestones, like as you've progressed, what role did that play in keeping you motivated to do what you're doing?
Yeah. Okay. So one of the things I always like when I hear from people, young people, is that they're engaged and they're paying attention.
Mm-hmm.
And so for I started using Excel to track my dividends. Oh boy, the previous century. In the 20th century, and I have I've got a page in my spreadsheet. I have like a 6-page portfolio workbook with
Mm-hmm.
a one spreadsheet is just the dividend payers, and I busted them up into like 4 categories. I had ETFs, I had stocks with risk, stocks with less risk, and then I had tech
Mm.
tech that pay dividends, like Broadcom.
Yeah.
And so then basically what I did was, I wanted to have a diversification by those criteria. And then what I really was just monitoring was how things changed, and and why they changed. And then now these days, now Schwab is doing a better job of this now, where they have all kinds of dividend information on their homepage. Okay. And I've used Schwab a lot. So, and there's a story I want to tell about this, and I really want to make an impression on people about just the value of paying attention.
Mm-hmm.
Um, in the 2008 crash, a lot of that was driven because subprime mortgages were resold as prime mortgages. Okay. And it was something called a CDO, collateralized debt obligation. Okay. Well, I got out in 2008. Now I was down to 25% equity. And the reason is I owned some of those CDOs and they crashed,
Mm.
but they crashed in '07. And I was paying attention. And I said to myself, what in God's earth is dropping 10% a day for a whole week? Now I sold out, but I learned it was it was a CDO, a subprime mortgage, mistakenly credit rated as prime and sold. And so but the thing really was I was just paying attention. And so what I think my message to everybody should be is that the time that you spend in understanding what's happening is a great, wonderful, fabulous investment. And my stepfather did the opposite. He said, "Oh, I just let my broker do it. I never look at it. My broker takes care of it. I don't need to be involved." And his broker was a dipshit,
Mm.
and was ignoring it because Ray was ignoring it, and it dropped 50% in value.
And that never, I mean, not that 50% in value dropping is ever a good thing, but like, it seems like that never happens at a good time. Like, it's like, oh, I need the pool for my portfolio. Oh, it's 50% less than it used to be.
Yeah. So, and you know what I that's I and here, this is a problem I struggle with my own friends is they, like we all go through this, right? Where our friends think this is boring
Mm-hmm.
and they don't want to talk about it, and it also is even like unpleasant. And so I have friends who totally rely on the broker, and I argue with them and I tell them that's a mistake.
Yeah. Well, and see, the thing is, it's again, self-fulfilling prophecy, because what happens is people see I pay, Jim Bob, he's my broker, he's getting me 6% returns. I'm making 6% of my money. I'm like, yeah, what if I told you could put it in the S&P 500, not pay his 2% fee, and you could get 10% returns? So it's one of those things where nobody seems to understand the concept of opportunity cost. Like, that seems like the most like, people understand the Pythagorean theorem, but they don't understand opportunity cost. And I'm just like, how, like, this is basically literally saying this might not be a bad option, but there are better ones, and vice versa. This might not be a good option, but there are worse. And like, it's just how it works. So there's always something better and there's always something worse. And that's what opportunity cost is like, is it worth it for you to do something else other than what you're doing? And people just don't understand that.
And that's what one of the things that makes these 5% on money market funds these days.
Yeah.
Such a great opportunity, and it really, I think we should all count our blessings that for however much longer we get to have this.
Yeah. Well, I mean, I did a video at the very beginning of the year talking about like my plans for 2024. What are my cash, like what's my cash looking like and stuff. The wife and I are in the process of saving for a house. We have a separate house savings account that's with Fidelity. It's in a brokerage account, but it's SPRXX. So it's not SPAXX, but it's getting me 5.02% interest. We've already received over $100 in interest on the cash that we're just putting in there anyway. And I was like, I'm not going to put it with a bank. I'm not getting anywhere near the interest. And I can just put it in my brokerage. I'm in my brokerage every day, so I get to see that. And we just been doing that. And like, I also, I'm not getting like a lot of engagement on the channel. So like, sometimes I ask my own questions, like things that I think people would ask. And one of the questions was like, oh, Troy, hey, what are you going to do when, J Powell cuts rates and interest starts going down? I'm like, well, I'm going to look at that as a glass half full approach, because as the interest rates on the cash in my account come down, the purpose of that money is to be used to buy a house. We're going to be building a house. So therefore my mortgage rate is also going to come down. So it's kind of like a good thing in disguise, where it's like, yeah, now I'm not earning as much as I was off the interest in my account. That stinks. But now I'm not paying 7% for a mortgage. I'm only paying 4.5%.
Yeah. And when it comes to interest rates, almost always there is that kind of double-edged sword. And I'm glad you brought up buying a house and being married. It's, where I live, I mean, it is just an incredibly significant thing just to own a house and not be a renter, because rent is just incredible here. Now, tax laws have changed over time, but I want to say too that family life and marriage and divorce can have incredible financial consequences. I have seen my friends' lives be changed so radically by things like child support. And I'm sorry this is depressing to people your age, but it's a reality that I've seen happen to my friends.
Yeah.
And so I guess, my message around that is that, you gotta realize that, being married is means you have a business partner, and this has a profound effect on your future. And so I would say cultivate a business. Let's say cultivate participation and having a shared set of values with your partner.
Yeah. Yeah. I think that's really big to everybody always says communication is really big, but like, I think communication of like the goals and the plans and the strategy of the whole thing. Like, I just had to talk with the wife about that. I don't know, probably 3-4 weeks ago. I was like, hey, here's like, well, obviously we've talked about this hundreds of times before, but like recently was like 2 or 3 weeks ago. And I was just like, hey, here's what I'm thinking. Here's how much we're currently putting back per month. I think if we can continue this, we're going to do X, Y, Z, and like just have the whole thing, because then instead of one person being excited about the progress that's going to be made and the goals and stuff like that, and then the other person just being like, oh, we don't ever get to do anything fun because all we're doing is saving. Like they're looking at the goal from a different, like cloudier point of view, and I'm looking at it from the sunny point of view. If I express that, or whoever is managing the finances in a relationship, if you don't even need, like, my wife isn't like ignorant when it comes to finance, but she doesn't care about it as much as like I do, clearly. So like, if I can express my excitement and get her to see the story, she doesn't need to see the details of the story because she's not interested in the details. But if I can give her the final outcome of, we're going to be able to, in just 5 years, we're going to be able to do this, we're going to have this, we're going to do this. In 7 years, we're going to have a paid off mortgage on a brand new house, like all the things, we're going to have this much equity, all these things. Like, that's how you get the other person to stick with it. And like, then it's like you said, it's a corporation, it's a business. Then you have two people working the same, like, other than politics, like, which is what we do now, where we have two sides pointing opposite directions and you're just pulling the rope. We're going to have two people working in the same way and we're going to get the same path. So.
Yeah. Okay. It's music to my ears to hear you talk like that and have that be our message.
Yeah.
Because I've seen the consequences of not.
Yeah, exactly. Well, and again, goes back to opportunity cost. Like, there's literally, I could not take the time to explain this to my wife, But what's the risk if I don't do that? The risk is that she doesn't have the same plans. Like everything goes awry, like you're talking about. You can split everything 50-50. Like that's not good. Like that's not worth the opportunity cost. The opportunity cost is for me to take 20 minutes out of my day to explain something that I already have ran through in my head thousands of times. And I can explain it to her, and then she gets the same story, and now we're on the same page. And I might have to refresh her mind every quarter. Who cares? But like, it's still worth the 20 minutes. So like, I used to say that at work when I was at work is two things. One, there was a sign on my 5th grade principal's window when I would go in, and this was a smaller school, but it says, I don't look busy because I did it right the first time. And like, that was a thing that stuck with me. And it's kind of one of the things where like, even when I'm at work, I would rather take 10 minutes longer than the next guy to do the same thing. But in that 10 minutes, I triple checked my work, and I'm never going to see that thing again. Versus this person that did it 10 minutes quicker than me, that's fine. They're going to see it 3 more times for 20 minutes apiece trying to fix the mistakes they made the first time. So it's kind of one of those things where like just understanding the opportunity cost and the risk of not doing the extra work, and then what, like, is it worth it?
And that reminds me of I worked for the Wrigley Gum Company for 14 years. And I'll never forget when I interviewed for the job, they asked me, how can you describe the style of your work? And I told them, I'm not going to be your fastest person. I'm not. But what I am going to be is I'm going to be the most attention to detail. Mm-hmm. And that is why you should hire me. And they agreed with me.
Yeah.
And they said, yes, we don't want the person who's the fastest. We want the person who's got attention to detail.
Yeah.
And they hired me.
Yeah. And that's, I mean, that's what you see with, going back to Tesla, like I really like Teslas and stuff, but like when Tesla makes a new model, they work so fast and like so quickly to get that vehicle out. That's why the first, like everybody knows you don't buy low VIN Teslas. Because the first cars of their thing, like the Cybertruck when it first comes out, the Model Y when it first comes out, Model 3, all these things, they're going to have so many QC things because they're just worried about getting product on the road that they have all these things. And what do they have to do? Oh, I just found out my headlight's letting in water. I have to take it to a Tesla service center or have a Tesla mechanic come out and look at it and fix it. Why? Because they didn't take time to do it right the first time. They'd rather get the product out and have to look at it 3 or 4 more times than take an extra 2 weeks to get the product out. And that, I mean, it's not just a Tesla thing. Like I said, I love Tesla. I own Tesla. I will own a Tesla vehicle at some point whenever my car blows up. But so it's one of those things where it's just like everybody does that. And so that's why your company probably thought that was a breath of fresh air, where it's like, hey, finally somebody that gets it, that it's not about the speed, it's about the quality.
And now you're reminding me of Boeing.
Yeah. I mean, that's exactly what Boeing's doing. Boeing's just, we're trying to get planes out. We have all these orders to fill. They already have backlogs of plane orderings and all kinds of stuff. They're like, hey, we don't need to make sure the doors stay on in the flight. Like, they'll handle that some other time. Like, what are we doing? Like, of course that's important. Take your time. Yeah. I don't know what they're doing.
Yeah. So, this even reminds me of my dentist. So he told me, he's my college roommate is my dentist. And he told me what's happening in the dental world is that people are owning dental practices that are not dentists, and they don't really care about having it be perfect. They care about having it be profitable. And that's a different goal for a dentist, having everyone's teeth perfect as opposed to making the most money.
Yeah.
And I remember I went to one of these people one time, and I have a couple crowns. And this was 5 years ago. And they wanted to remove my crowns, even though they were healthy, because it created revenue for them.
Yeah.
And I said no. And I went back, and that was 5 years. I still have both crowns, and they're fine. So when this is like, Tesla and Boeing, this is this phenomena that's happening today where, the balance sheet and the income statement are being prioritized over the quality check.
Yep. And I'm glad you said that, because that's exactly where I was going with that, is like these companies are getting so much pressure from the stock market. They're petrified of their stock price going down 10% because they missed earnings. So what they're doing is they're out here saying, hey, Tesla needs to show that they pushed out $500,000 or 500,000 units last quarter, and they need to get them out, because they can't have, hey, we only pushed out 380,000, but the quality on them was perfect. Wall Street doesn't care about that. Investors don't care about that. So they're kind of damned if they do and damned if they don't kind of thing, where that's like, okay, do we take time and disappoint the market because we didn't have as much as they expected us to have? Or do we have as much or more than they expected us to have, but then we're disappointing our customers, which I could argue that one's worse because the customers are the ones buying your product. You're not going to have a lot of cars to put out if nobody's buying them. Like, what are you going to do with that?
Yeah, so this and Boeing and Tesla, luckily, is something everybody can relate to. But they're part of this phenomenon nowadays. So I guess as far as like investors, I guess we have to realize that this bad influence exists in our investment world.
Mm-hmm.
And when it's people like Boeing and Tesla, I guess now that's hard to figure out, who's really affected by that and who isn't. But it's a dangerous reality, and it reminds me of when I bought that BP stock. So I mean, basically, like let's say when you're dealing with anything that's going to be a safety, like a vehicle, any kind of vehicle, that you've got to have the priorities of safety balanced with the priorities of profit, and that's not happening.
Yeah, I agree. I mean, it is worrisome too, because like it's I mean, look at what Boeing did. Like they're pushing out of these planes just to have them not pass quality control. Then they're having to ground the planes, and then they're getting orders canceled because their quality control is not good. And I'm just like, it's literally a recurring effect of like a poor initial decision is causing everything that you were making poor decisions for, such as timeliness, profit, getting things out, stuff like that, is the exact things it's doing against you. Like, because you're doing all that, you're grounding planes. People aren't buying your planes because now they're worried about it. That Southwest isn't going to buy your Boeing planes because they're like, oh, hey, Southwest just bought more of this company and their planes are falling out of the sky. Let's buy more of those. Like, nobody's doing that. Like, Southwest doesn't want to take the reputation hit of a Southwest Boeing plane just crashed. What do they hear? Southwest and Boeing. Like, that's what they hear. So then both the companies take a hit. Southwest the airline industry in general is not, in the position to do that really. So, because they're still recovering.
It reminds me of one thing that we also all need to be cognizant of is greed.
Yeah.
You know what? There is plenty of that going around, and it has a detrimental effect, and it's a dangerous thing, and this whole SPAC phenomenon. Remember that a couple of years ago, and there was some radical, this kind of shit happening with companies that didn't make a profit. And you know what? And people get, of course, you've heard FOMO. Everybody knows FOMO, right? And greed and FOMO cost people money.
Yeah. I don't know. I don't really know what needs to happen with that, but I mean, at the end of the day, it's just the market doing what the market does, and the people will weed themselves out where they'll buy FOMO stocks. They'll think investing is not for them, which sadly they're just doing it wrong. But what do I know? Anyway, okay. So next question for you. So you live partially off your portfolio. So this is a good question for you. So at what point would you get to where you would feel comfortable enough to not work at all, like live 100% off your portfolio? In other words, like how would you know when enough is enough? Or do you just do what you do because you enjoy doing it?
Well, that's a good question. And really the thing was, and I'm glad we're talking about this now. See, my real goal about my portfolio supplementing my monthly budget was to go part-time. So when I was 46 in the year 2006, I left full-time work for good. I've never worked full-time again. And I had, at that time, what I was doing was I was working part-time and collecting dividends. And I was, spending probably half of my dividend income, and I had a paycheck. But it was a part-time. I've been a school teacher for 15 years, part-time substitute school teacher. So, and I really want to say that this is why I think time is better than money. My working part-time meant more to me in terms of stress and happiness than the money did. Just the fact that I only worked 3 or 4 days a week and had summer off was an incredibly valuable thing to me that I want to stress and emphasize, that I really feel raised the quality of my life.
Yeah.
And paid for partly by dividends.
Yeah.
Now I'll say, okay, now I have been in a position for a long time where I could live completely off dividends. Well, boy. Well, see, I also get Social Security.
Mm-hmm.
So I'm not working because I need the money. That hasn't been true. So for about probably about 10 years, where I didn't need to work. But really, now when I got started getting Social Security, then I could retire and save money easily. Quite a bit really. I'm the my cash flow is healthy, but I love to teach school, and part of the reason is so the kids, I do the young kids, kinder through 4. They really they have this great work ethic and this integrity about learning as much as they can. And you know what? I like that. I enjoy it. So I go teach school partly just because of that. And also the fact that I don't have to do middle school, because being a substitute teacher in middle school is insane. And so, so, uh, you know, but also, let's see. So I get, yeah. So, um, yeah, I could retire. And the fact that I can work just 2 days a week is priceless.
Yeah.
Working 5 days a week to me was really hard. It was really, it depressed me.
So I guess the follow-up question to that would be like, if you were at a point in your life where it was either work full-time or not work at all, you would just choose, like, you're at the point in your life where you could choose not working at all.
Yeah.
So when you crossed that path, like, let's just take Social Security out of it just for now. When you crossed that path, was it quite literally dividends equal expenses, or did you try to aim for some number over that to account for like your occasional, especially since you said you do own ETFs, and like we all know ETF payments are not, like Coca-Cola, where it pays this much, then the next year it pays a little bit more kind of thing. Like ETFs kind of bounce around. So like, was it a certain number you were shooting for? Was it like, I want to have 110% of my expenses covered by my dividend portfolio, or how'd you handle that? How would you handle that?
Well, now, prior to Social Security, my dividends didn't pay all of my expenses. They probably paid 80% of them. And actually, I I worked partially because I didn't want to. I wanted to reinvest some of my dividends. One of the reasons that I kept working. But as far as like you know, um, so I would be uncomfortable if it was just a case of my dividends were equal to my monthly expenses. That wouldn't be the point where I would completely stop working. Um, because that's like to me, I'm a big safety net, margin of error kind of person, where I don't want to push the envelope. I want to stay well within it. So like what I would, if I was going to make, say, I think actually 120%. Let's say I had 120%. My dividend income was 120% of my monthly expenses. That would be a point where, and I'm saying this is without Social Security.
Yeah.
Okay.
Yep.
At that point, because I would like a healthy margin of error comparing my cash flow to my expenses.
Yeah, I mean, I've talked about, so I'm not going to go too into depth to this, but I've talked about this before. So mine is going to be 110, but the only reason it's 110 is because in my quote unquote expenses, I'm going to be including how much I'm still investing per month and how much I'm saving per month. So like my expenses aren't going to be, oh, my bills come out to $2,000. It's going to be like, my bills come out to $2,000. I'm investing $1,000 and saving $500. So really, my expenses are whatever that would be, $3,500 a month, and I want 110% of that. So like that's how I'm fathoming it, where that way I can see exactly what you were talking about, where like you're still working part-time, one, because you enjoy it, and then two, because you didn't want to spend all of your dividends. I'm going to be retired and still able to invest $1,000 per month off of my dividend portfolio.
Yeah, right. And when for everyone in general, you know, I think that having free cash flow is a tremendous thing, and there can be surprises for you, and also like you said, the opportunity. So that free cash flow that you can invest back in, where and also, and I got to say, you're let's say, you know, you're you have to your generation has to plan to live to be 80 for sure. And you know what? That's going to cost a lot of money.
Yeah. Well, yeah, and that's the thing that I have to consider, and I am considering is I personally want to live to 100. Obviously, I only have limited control about that. But if I want to retire at 50 and I plan to live to 100, that means I have 50 years worth of not working expenses that I need to cover. So that's what I'm really trying to plan for, and that's why I want to still continue to grow my portfolio, because it's not like, oh, okay, I won the game, I'm retiring early at 50 years old, I'm selling out of my stock portfolio. That's not my intent. So my intent is to keep investing. It's just okay, at 50, here's a checkpoint. And then from here on, I might change a strategy or something to modify from that point forward. And you might change it again when you hit 80 or whatever it is. Who knows? But yeah, I don't know. I just asking that question, how do you know when enough's enough? Because it is a question. Some people are just oh yeah, I don't know. Because the thing I always I always bat this back and forth is in dividend investing, especially when you are paying attention, like you were talking about earlier, we know that the dividend snowball is real. So the thing that makes it hard is you're okay, in year 20, I'm going to make $80,000 a year in dividends. But in year 21, because of compounding, that's going to be $88,000. And then the next year it could be $100,000. You're just okay, what, when do I pull? Because at the you might not need 100% of what you're going to make in dividends, but also by withdrawing some of your dividends, you're substantially slowing down that snowball. So it's one of those things, do I want to mess this up? And then how long do you realistically need to keep it going? To the point where, you were talking about earlier, to the point where you're getting greedy. Do you need $208,000 a year in dividend income? Probably not. Maybe you do in California, but here I don't.
Well, that's a really good point, and I'm glad you bring that up. And one of the reasons is because what the dilemma that faces people my age, okay, and my other college roommates, a classic story of this is, how do you balance saving for a long life versus the fact that when you're 64, your friends start to die.
Yeah.
You have to realize that you don't have forever anymore, and you can't just save all your money. You got to actually spend some and raise the quality of your life. And so, my buddy Roger, he works full time, and he was going to work full time till he was 70. And I told him he was bananas because he didn't need to. He was doing it because he wanted to be as rich as possible when he actually stopped. And I said, but what if you die at 69 and you never retired? And so people my age, it's this question of how, when you're 64 and your friends die, how much do you spend on today and how much do you save for tomorrow?
Yeah. Yeah. I mean, in theory, the odds of, dying, as morbid as this is, the odds of dying increase as you get older. That's how it works. But we never, I'm over here saving for a goal. It's really hard for really young investors, which is why I try to educate as much as I can on that, either with the channel or on Facebook when we're talking in those groups. It's really hard for a 20-year-old to plan for when he's 60. That's 3 times longer than he's lived. He's just okay, what do you want to do 40 years from now? I'm I haven't even lived that long. I don't know what I want to do. I don't know what I do when I'm 60. How am I supposed to plan for that? So that is that's just me asking you, what do you want to do when you're 130? You haven't even lived to half of that yet. How are you supposed to know? And also, kudos to you for making it to 130. At that point, you're just lucky if you could tie your shoe, much less having fun. But yeah, I don't know. So yeah, it's just something to think about with that. So okay, next question for you. I want to know, do you have any specific criteria that you use? Because you did mention that you use Excel sheets, which I really like because I think that's underrated. So do you have certain criteria that you use to select your stocks? All your stocks need to meet X, Y, Z, or do you just kind of pick them in a different way?
Well, now I have had a great amount of luck with the Schwab stock screener. And I go in there, and have you ever used it?
No, I have Fidelity. I've used their screener a little bit, but I have my own criteria that I use, which I might be able to use on Fidelity, but I'm not sure. So I just have my own criteria that I run them through.
Well, it's not, there's nothing special about Schwab,
Yeah.
So one of the things that I've done a great deal is I'm a fan of REITs, and I have been for decades, several decades. And so I put in these parameters where, I need this market cap, I need this dividend rate, and I need this growth rate of revenue. And I put those factors into the stock screener, and then I end up with a list, and then I might refine it a little bit better. And then I might say, type in, let's say, broadest coverage of the United States, something like that. And then I get a list of stocks. And that stock screener, has been a great thing for me. And like, it's really good for looking at risk, because you can say, okay, I only want Morningstar 5-star companies. And I only want companies that pay between 4 and 6%, because, you get if you start looking at companies that yield 8 or 9%, you're chasing yield. Mm-hmm. Right. And so with the stock screener, you say, I don't care about anyone who pays more than 6%. I don't want to even bother looking at their prospectus, because it's chasing yield. And that thing has been a big advantage for me.
Yeah, I think it's so underrated to have hard filters like that. So 2 things I want to touch on, and I've touched on this before, but I think it's so important. One, the importance of hard filters. So like, I've told the story a bunch of times. On the Facebook group that we're part of, I came up with my criteria, and because it's the internet, like everybody always has something to say on the internet. So I was like, okay, I'm going to post my criteria on the internet, and I'm going to challenge somebody to find what they would consider to be a bad stock using my criteria. Cause I don't dive into like the fancy metric. I don't understand them. Like some of the metrics confuse me. So like this percentage and EBITDA and all that stuff, like I get it in theory, but like putting it to practice, like I can't do it. It doesn't make sense in my head. So like I was like, oh, how many of these complex criteria can I fit into simple things that I understand? So, I mean, and I have the video on my channel talking about all my criteria and stuff like that. So that was my challenge. I posted my criteria on the Facebook page and I said, hey, find me something that meets this criteria that you would consider a bad stock and share it with me. On the internet, nobody could find anything. There were people that said, oh, it meets these 2, but doesn't meet this one, or it's really close to that. And I was like, okay, well, that's not how filtering works. Because that's what I was just talking about with you, is having hard filters by saying, you said 6%. It's not going to show you something that's 6.2% and say, this one might be. It doesn't do that. It says, here's your cap. Everything else above and below doesn't matter. So like, that's one thing. And then also another thing that you talked about that I think is super important is the value of refining your criteria when you get too many results. Because that's exactly what you did, is you were like, hey, I did these filters. I thought they were really good, but there's 236 stocks here. I'm not looking through that. So you're like, okay, I can make this one a little, maybe I'm looking for stocks between 5 and 6% instead of 4 and 6%. Maybe I want, instead of this number being 90%, maybe I want it 94% and higher or whatever. And you can do that. And you're like, oh, okay, now I'm down to 11 stocks. I can look through those.
Yes, exactly. Yeah, so I've done a ton of that on Schwab for a long time.
The thing that grinds my gears is that when people do filters, like they finally understand, they're like, oh, I need to have filters. But when your filters come back and you have like you literally filtered off 7 stocks out of the 1,000 that you were looking for, I'm like, your filters suck. Like you're not doing yourself any favors. The idea behind a filter is to get rid of everything that doesn't meet exactly what you're looking for and just gives you this small refined list. And you're not going to, in most cases, you're not going to filter and literally get one stock. Like that's very rare. But if you can get something down from 1,000 to 11 or whatever the small number is, that's when you're like, okay, now let me look through here and start comparing these companies and which one do I like better? Maybe one's in a sector I'm a little light in or whatever. And you can start like picking from there. That's how you do it.
Yeah, and I have just done an enormous amount of that for a really long time, exactly the way you described it.
Yeah, I think it's so underrated. People, like, I've talked probably, I don't know, 2 or 3 comments in the past week on that Facebook group where I'm just talking to people and I'm just like, okay, like, one, what's your goal of your portfolio? What's your timeline? Do you have 5 years left? Do you have 50 years left? It makes a big difference. And 2, when you give me this list of stocks and you're like, how does it look? I'm 26. I'm like, yeah, there's so much. Like you could be 26 wanting to retire at 30. You could be 26 wanting to retire at 70. I don't care about your age. Your age doesn't matter. So like that. And then also when you pick these stocks, the most important question I like to ask is like, what metrics did you use to pick those? Or were you just picking them out of a hat? Because like that shows you what you need to do. Like, okay, maybe you don't have criteria. Well, start there. Figure out what you want your stocks to do. What kind of metrics do you care about that you want all your stocks in your portfolio to have? What do they share in common? And then it's real easy. Again, you can add it to the Schwab filter, whatever filters you want to use. And you can be like, I want it to do this, 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 this. And then here's your list. And you don't have to buy them all, or you can buy them all. It doesn't matter to me. It's your money. But like, that's how you should do it. So when people are asking those questions on those groups, I'm just like, okay, age. Actually, I don't care about your age. Goals, timeline, and criteria. Those are the things you need to answer.
Yeah, and I think the tool that we have of it. Well, let's see now. Okay, I'm expecting a lot from Fidelity. I'm not on Fidelity, but they have a great reputation,
Mm-hmm.
and so I would expect that their tool for stock screener is probably sophisticated and robust.
That's
Uh,
one of the reasons I don't use it, because it's asking a bunch of questions I don't know how to answer. It's just like,
uh,
what do you want this number to be? I'm like, I don't even know what that number means. Like,
yeah, yeah. And so now, this is also a thing of where like you know, it's not something. Rome isn't built in a day. That's
mhm.
the saying I'm going to use for this. So when it comes to, I want to say to people in general about stock screeners is that what should people should do is just get something like a general, like just say market cap and PE, and just sort for that, just so you get a kind of general feel of the way that a stock screener works. And you don't have to use two parameters, market cap and PE, and not necessarily just as a, let's say, because like I said, my belief is that the the how well informed you are is going to determine how well you do.
Mm-hmm. Well, I mean, so think about this. So when you first, not you specifically, but when people first get started with dividend investing, what's one of the first lists that you can think of that people gravitate towards?
Um, let's see. Um, the tracking ones, the ones that track the S&P and the ones that track the Nasdaq.
So that is I mean, there's multiple answers to that, but the answer I was thinking of is the Kings and Aristocrats list, right?
Oh, okay, yeah. And like I say, I want to stay humble. Okay, there is plenty that I do not know.
Mm-hmm.
Okay, so you could easily get out of my area of understanding. It wouldn't be hard.
No. Yeah,
And
no, you're fine. So like, it was just like, so when I first started, and I have some subscribers that really appreciate that list, and I was one of those people too. I was like, oh, Kings and Aristocrats list. What are you doing? Like, what is the point of the Kings and Aristocrats list? It's literally a list of stocks that was the whole stock market. What do? They add filters. What was the filter? Pays a dividend. It is, I think for the Kings, it has to be part of the S&P 500, or maybe the Aristocrats. One of them, I don't know. One of them has to be part of the S&P 500. There's another filter. The other one has a dividend streak of at least 25 years. Another filter. Guess what? Guess who's not part of the S&P 500? A stock that's not part of the Kings and Aristocrats. Oh, it's a company that doesn't pay a dividend. Guess who's not part of it? A company that's paid for 24 years or less. Like, it's just, that's how filters work. And literally, people, when they first get started in dividend investing, that's one of the first lists they gravitate towards. Why? Because it's a list of filtered stocks through criteria that met these things. That's what it was. And your job is, you can use somebody else's filtered list, or you can use your own filtered list and come up with your own criteria that's important for your methods and your goals and your strategy and your risk tolerance and all the things. That's literally what we're talking about.
yeah, and actually, I mean, I love those dividend aristocrat things. And you're when people understand, why is something on the list.
Yeah, exactly.
I think they're armed with knowledge.
Yeah, and like that's what I was talking about before. So that's actually one of our last questions, but not yet. But that's one of our last questions. Is like the tips that you would give, and the tip that I give is like, if you have no interest in investing, S&P 500, just put your money in there. Never worry about it. But what happens sometimes is people are like, hey, this S&P 5, like my dad just started my dad doesn't care about investing. He asked me, he was like, hey, I have work. They have a 401k match, whatever. I was like, do whatever you can to get the match. Put it in the S&P 500. Don't worry about it. And now he's starting to like, oh, this is cool. It's up this much percentage in the last year. And since I bought it, it's up 11%, whatever. I'm like, yeah, that's how it works. And then like slowly, sometimes people gain an interest. They're like, oh, okay, that's cool. S&P 500 is doing this. Is there anything else that's an index fund like this? Or like, what is the S&P 500? Oh, it's an index fund. Cool. Are there other index funds? Yeah. What do they track? Okay, cool. What makes up the S&P 500? Like, what's the allocation of the stocks? Oh, okay, it owns a lot of Apple and Microsoft. Can I own Apple and Microsoft? Yes, you can. You can own them by themselves. And like, you go down the rabbit hole of becoming whatever kind of investor you are going to end up becoming. Or like I said, worst case scenario, you don't give three craps. You just have some money and you want to have more money later. Invest. That's all you got to do. Like, you're not going to get rich by putting it under your mattress. That's not how it works. That's another soapbox. But I don't know how many soapboxes I have, but that's another one. So,
Well, this is something I experience quite often because I talk to people who are not real interested in investing.
mm-hmm.
way less than you and I. And I think so. One of the things is we have to realize that what, we are birds of a feather, but there's a lot of people who just their level of interest and energy towards it is way less.
Yeah. I mean, the sad part is most people don't care about investing or retiring until, not necessarily it's too late, but they're like, oh, I'm 50. Now I need to start worrying about it. I'm like, you just missed the best 3 decades of your life for investing. Like your 20s, 30s, and your 40s, worse. 30s, a little bit better. 20s, even better. And if you can happen to catch a teens in there, some part of your teens, you're like we are investing for my son. He's 1. And like he has the S&P 500 and he has the NASDAQ. And that's all we're doing in here until he gains an interest. And if he doesn't, he's going to continue to have the S&P 500 and NASDAQ. We're just splitting it 50-50. That's all we're doing. But he started that when he was born. So by the time he's 30, he'll have 3 decades worth of compounding in that account. You can't beat that. Like literally he'll be outperforming people that have put tens of thousands or hundreds of thousands of dollars in there. And he's only put, whatever, $1,000 in there. And he's outperforming their returns because he has 30 years worth of work in there.
Yeah. Yeah. And so I want to ask you a question. So let's see this, there's a radical difference between your generation and my generation in terms of early adoption of retirement planning.
Mm-hmm.
And so I'm thinking your generation had a couple of advantages, and that is the internet and a phone. But I want you to tell me, why is your generation much more involved than mine?
So that's interesting that you say that, because like in speaking with people that are around my age, I seen the stats. I think it was 52% of people have something invested like in the stock market or something like that, whether it's, CDs, bonds, whatever, or actual stock market. So that would mean 48%, just by my math, don't have anything invested. I'd be curious what the age breakdown of that is. But in my experience, it's way more than 48% of people that I talk to that are around my age that aren't invested. So like when I go to the gym and I'm talking to all these people, most people don't care. A lot of people were also rubbed the wrong way during the whole COVID thing, because they weren't understanding anything about investing. That was the period of time where you could buy something and anything went up. It could literally be about to go back. Like look at GameStop and AMC. Both of those are like doing horrible, but everybody bought them. They made a lot of, some people made a lot of money, some people didn't. So like a lot of people in my generation or even younger are really jaded by that. They're like, oh, investing's a scam. I don't, but like, it's whatever. It's not for me. Like whatever. It's just a way to transfer money to the wealthy or whatever. I'm like, no, your version of quote unquote investing was what the problem was. And they don't see it like that, which is why when I ask that question of like your biggest mistake, it's not even about the mistake. It's the lesson learned, because that's what people don't do. And that's what I try to get through with this series, like both to my guest and me understanding my guest mistake, but also everybody that watches this is the mistake sucks. Obviously the idea is that you make your mistakes earlier because it costs less money because you have less money to make the mistake with. But also is if you can extract not only the lesson, but the correct lesson from the mistake you made, that's how you know you won't do it again. Now, not to say you won't also make other mistakes, because that's what we do next is we find something else to throw away our money away with. That's how it works. But like the idea is a mistake was worth making if you don't make it again. I don't know if that's a quote, but I just thought of that. So that's really good. I'll put that on a t-shirt or something. But like, that's the idea of the mistake is like, okay, cool. Made this mistake. Here's the lesson I can take out of it. I know I'm never going to do that again. Or maybe that's just another thing you add a filter to. And that's another thing that you filter for. And you're like, okay, this was a thing I did before. Now I really understand this. I want to do that. And like, at the end of the day, I realize that talking in this interview series and stuff like that, a lot of people are just going to be like, oh, this, whatever, young kid, just whatever. The idea is, there's going to be one person that watches this and like, oh, that's a really good point. I'm not going to make that mistake. Most people need to make the mistakes on their own because like it doesn't hurt the same unless you do it yourself, which I understand. But also, if there's that one person that we can get to not chase yield or not understand that just because, in your case, not understand that just because a company was good and is having hard times, they don't always rebound. That's not how it works. And that was the mistake that you learned is you're like, oh, BP, really good. I already own it. I want to own more of it. Surely it's never going to go anywhere. Like it has to come up, right? Well, that's like basically the end of your due diligence that you did at that point from the sounds of it. And you didn't do anything else. And like, that's what cost you. And that was the mistake and lesson learned. So I don't know if that answers your question or not, but like,
Yeah, no, it really does. And
yeah.
and I think that mistakes is a very important thing when it comes to the situation we're in. And that's why I love that risk pyramid, because I think when you have to understand how much risk you're taking all the time. And it's important to take some risk. Okay, but you need to understand that you have to manage the risk so that when you do make mistakes, it's not with 25% of your portfolio.
Yeah. Yeah. And like I said, in the beginning, when your portfolio is small and stuff like that, if you do make a mistake where you lose 50% of your portfolio was $1,000. You lost $500. Cool. That sucks. But like, the idea is people learn from that mistake and don't make the same 50% mistake. Because what happens is they don't learn, then their portfolio gets up to $100,000, then they lose 50% of their portfolio. Now they're talking $5,000 or $50,000. That hurts a lot more. So like the mistakes pretend this mistake always cost 50% of your portfolio. That one always costs 10%. This one always costs 3%. It's always going to cost that. The idea is that every time you make that mistake, it costs that amount. You don't want to make all those mistakes at the end, because then you're screwed.
Yeah.
So I don't know. That's just the way I think of it, is like, I'd rather get all my mistakes out of the way and like stay within I think it's Buffett that calls it his circle of competence. Like, you just stay within that. Like, you can branch out a little bit, but understand, like you said, make that a small percent of your portfolio. If you want to branch out 1% and you want to put 1% into something speculative, cool. You lost 1% of your portfolio. Maybe you turn 1% of your portfolio into 10% of your portfolio. That's perfect. Mm-hmm. So that's how, I don't know. Yeah. That's how it works.
Well, that's risk is an opportunity.
Yeah, it is. I mean, at the end of the day, like during basically since 2000, pretty much since 2000, like tech has been the thing, right? But then in 2022, what took the biggest hit? It was tech. Tech got destroyed. Tech was like, the S&P was down. What was it? 22%, something, 19%, something like that. But tech was down like 30.
Yeah.
So like, that's the risk you take. Okay, yeah, cool. It's going to have great gains. And that's what we go talk about before with volatility. Like, people seem to think it's only, tech only goes up 30% every year. No, it also goes down 30%. Like, there's different times when that happens. And like, there's also times where it'll go up 30% for 6 years in a row, and then it'll go down 50%. And going back to what we were talking about before, is people seem to think, especially like people that like wait for certain prices, they're so obsessed with buying dips that they waited, like they'll wait for a stock to go up 10% over the course of a year just for it to go down 3%. And they'll think that they're getting a deal. I'm like, had you just dollar cost average the whole time, you would have been way better off than like, yeah, you got a 3% deal. Congratulations. But it was 10% cheaper a year ago.
Yeah. That's where I gotta get expressed by humility. You know what? That's really hard.
It is. That's why. That's why. Like, I have a series that I'm working on for the channel. I don't even know how I'm going to do this, but like, I have ideas that I have where it's like removing emotions from the market, and like, there's so many little strategies that I've done where I think I'm not an emotional person in general, but like, I've figured out ways to take like the emotions out of individual looking at my portfolio, because that's another thing, is I'm putting a stress on myself where some people set it and forget it. They do ETFs and they're on their way. They never look at it. They'll look at it once a year to see, I'm up, whatever. But me looking at it every day, I'm even more susceptible to like the emotions of the market on a day-to-day basis. J-Pow talked today. I'm down 2.5% in my portfolio. Like, I'm susceptible to that. But because I've learned to manage those emotions, it doesn't even bother me. I don't care. And like, I want to do a video series on that, because I think that's such a huge part, not even for like new investors, for experienced investors too, where they're like doing all kinds of different stuff where they're like, this is a little frothy. Should I sell out? Like my grandma, my mom's mom, did the same thing where like she let some guy, convince her that like whatever it was, I think it was Tesla. Now, obviously Tesla's having a down year, but he did this like 3 years ago, where he was like, Tesla's going to have a bad thing. And I was like, Tesla proceeded to go up 2 more years. And again, like I said before, bears are never wrong. They're just early. So like, now this guy looks like a genius because, Tesla's having a bad year so far. Elon already said that Tesla's in between 2 growth ways. Like, they're doing this thing. They're trying to, they brought that up as much as they could. Now they're in between this thing. They're trying to put a bunch of different, start a bunch of different cooks in different parts of the kitchen. And then they're going to go back up again, doing different things and better things. So like, I don't know. I'm not worried about it. I'm just lowering my cost basis. So I'm okay with it. But, okay, so I'm going to skip this question because I don't really get a lot of good. Actually, I'll ask it to you. You can let me know if you don't want to answer it. So, are there any dividend-related myths or misconceptions that you hear on a regular basis that just like generally aren't true, and you want to debunk them? If you don't have anything, we can skip it.
Yeah, no, we can skip.
Okay. Okay. So here's the last question. This is the cliffhanger for anybody that's still here in this lovely interview that we're doing. So the question I want to know is, it is still today's market. Everything's the same. Every stock price is the same. The rates are still the same. JPAL's still here. All the things. Only difference is you're 18. You have all the knowledge that you have right now. What do you do different? What do you do different? What do you do the same? What basically tips for your younger self?
Yeah, so there really, I thought about this a little bit too. And there's really like three things I got on my mind. And the first thing is you got to remember that when you get married, who you're married to is going to have a big effect on your financial life.
Mm-hmm.
That's a big deal. And another thing I want to say is time. Time. I just working part time just raised the quality of my life so much. And then I want to talk about energy, because energy is the thing that I think, in terms of investing for the future, where we're going to have the most robust and predictable increase in demand is going to be in energy. Now, exactly the details of how you can really score in energy, I'm not really sure, but I really think that is one of the things that is going to be there. And then I think the last thing that I think about is that managing risk should get equal, maybe not equal, but should get a healthy amount of your perspective in terms of your choices.
Yeah. I mean, those are like the time part of things. Like people, again, that goes back to what we were talking about before about like getting started early. Like not waiting until you're 50 to start planning for your retirement. Like I said, it's never too late, but you made it a lot harder for yourself. That's for sure. So like that. And then, I don't know. There's just so many, I don't know. It is a really good thing to think about. Cause so many people try to answer that question when I ask it. They're like, oh, I'd go back and buy Apple. I'm like, no. We're not going back and buying nothing. Like, I'm just saying from now, like, what are you doing? What are you doing in the future? Like, cause that's what we're trying to answer is like somebody's watching this or just getting started and they want to know, hey, what do I do different? Like, what did you do that was successful? What did you do that they shouldn't have done? And you'd be a little bit further had you not done that thing. So, that's really how I try to answer it.
Let me say two more things about that.
Yeah.
Okay. The thing about energy is that tech uses a lot of energy.
Yeah.
Electric cars and data systems. I mean, server farms use a lot of energy.
Mm-hmm.
So that, and the other thing is, the big mistake I made too was caring too much about high PEs. Like I said, one of the biggest mistakes I ever made was missing out on Amazon and Netflix because I was intimidated by the high PE.
Yeah. I mean, and that's one of the reasons I don't even use that metric is because PE, one, it's price to earnings. And especially when you're talking about forward PE, that's price to expected earnings, which is even crazier because that's just somebody's, expectations or whatever. But the other thing about it is like the PE that's acceptable for the energy industry versus the PE that's acceptable for the tech industry are vastly different things. And people try to look at them through the same lens. And I'm like, that's just not how that works. And then also, certain companies within a certain sector or industry just tend to trade at higher PE. Like, look at Costco. I would have never owned Costco because Costco is quote unquote always overvalued. Costco was $4.94 a share when I bought it. It's over $7.20 right now. Guess what's considered still overvalued? Costco. Guess what's still a great company? Costco. Guess what I buy every day? Costco. Don't care. Yeah. And you said, I think the bigger lesson isn't letting people scare you about PE for you. I think the bigger lesson is letting people tell you something is or isn't right for you. Like that's where you have to do your own research. And like you said, you have to understand your risk, your diversification, your timeline, your goals, your criteria, setting all those things in motion that we talked about throughout this interview. That's what's important. Because at the end of the day, if you let somebody convince you to buy a stock and you have no internal conviction about that stock, that's going to be the first one you start to waver on when times get rough.
Yeah. So, right. There's more than one right answer.
Mm-hmm. Yeah.
It depends on who you're talking to.
Yeah, exactly. Yeah. Yep. I agree with that. Well, anyway, Peter, I told you these things go a lot faster and a lot more fun than you would think. So it's been a blast and a pleasure speaking with you today. I hope you enjoyed your time on here. And if you have any closing remarks, the floor is all yours.
No, I really appreciate doing this. I see young people who are, facing the whole cost of real estate for your generation, especially around in California. To me, is causes a lot of struggle, and childcare is a lot of struggle. And so, if I can help anybody to just say, to recognize that time is their biggest advantage, and even $10 a month is a beginning, and time and working part-time made my life much better, and that's all.
Yep, I agree. Well, again, Peter, thank you. It was my pleasure speaking with you today. Thanks for sharing your story, and wish you nothing but the best. And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.